Hey, good morning, traders and investors, and welcome back to the Trading Analysis Wednesday live stream show. I'm your host, Bennett Tyndall. We appreciate you taking time out of your busy Wednesday mornings to join us. Can't believe we are already into the month of October. Q4 is upon us. Good morning, Enduro. Good morning, Alan. Glad to have you guys on board with us this morning. As you can see, bottom left-hand corner of your screen, markets have made a sizable move up from the recent lows that we established last Friday. We've actually seen a move up to the tune of better than 5% in the S&P 500. We're going to get to the wave counts in just a couple of minutes. Before we get to the wave counts, let's bring in the trading analysis team, including company founder Todd Gordon, Director of Investments for New Age Wealth Advisors. Good morning, gentlemen. How are you doing today? Welcome, welcome.
Morning, guys.
Morning, Bennett. Morning, guys.
Hey.
Morning. What's up? What's up?
Another beautiful day in Texas. Got a nice weather change
Raining
upon
and
us.
cold here.
Is it really already?
Upstate fall. That's the way it goes. What's going on, guys? Hey, what do you think? Elon on the bid for Twitter. What do you think?
Finally going to happen.
More chaos and drama in the world of Musk. I love it.
Twitter was up, what, 13% yesterday? Pretty big move. So do we buy now and just hold it till 54? How long?
It went right up to the close. It went right up to the sale price, and I guess he's taking private. So I'm going at the end. I put up a chart. I think there were some pretty interesting volume patterns in Tesla. So I'll show. I'm going to go at the end. I'll show you guys. But yeah, that was interesting, man. I was on CNBC talking about it yesterday. They threw me on last minute, and oh man, and so many people are saying he's staking his reputation. A couple guys are saying staking his reputation as a CEO based on success. I'm like, yo, the stock IPO'd in 2013 at 45. It's at 48 right now. So in 9 years, he generated $2 of shareholder return. So what, 8%? They've got 300 to 400 million monthly active users. Like, that's behind like Pinterest, Snapchat, Instagram, YouTube. They're at $1 billion, $1.5 billion, 2 billion. Like, it's a failed project. It's such an important, so important in our society in terms of getting information out. But from a social media money making, capitalistic point of view, it's a failure. So I say good.
Yeah, it's going to be interesting to see how that trades out. It looks like the high was in the 52 handle. And I think what his bid's 54.20. He had to find a way to put that in there. So it's characteristic of Elon. I'm excited to see where that goes. Looking at the chart, and I'm anxious to see what you have to say there. What if that's a big leading diagonal and three-wave pullback? I'm sure you're considering possibly a similar view in Twitter.
In Twitter.
Yeah.
And that's always a hard thing. I mean, this is primarily an Elliott Wave focused podcast. New stocks, because stocks are only 9 years old. And I think the average half-life or even, I forgot the statistic, 10 years is the average life of half the companies that come public or some statistic. It's hard to put a wave count on a chart or a company that's doesn't have a long-term history. Elliott Wave is really meant to track the long-term indexes, so it's hard with new issues. I would just caution on that.
Yeah, no, I completely agree with you on that. And what we will typically do is, oftentimes, as I'm sure you've seen, we'll have a new name that might trade patterns for a while before there's ever a wave count, established.
Right.
And in the case of Twitter, it's a good example.
It's just sideways, man. What a mess.
Yeah.
Anyway, sorry to take you off.
No, you're good. Anything specific you guys would like me to cover when I take it through the indexes?
No, it's so interesting. It's so good to be working short term with you guys. And I just rebalanced the wealth management portfolios. I've really been in the trenches, and I think that's so important in this kind of busy market, going through all the possibilities of where we are according to our beloved theory. And it's been fun working with you guys on this, trying to make way of this crazy market. So.
Yeah, it's been a challenging one. All right, let's hit it. We'll take them through the indexes, and we'll be back on the other side. Catch you, gentlemen, in just a couple of minutes. See you then. All right, good morning once again. Let's jump into it. Hard right edge of the trading analysis edition of the MotiveWave platform. We're going to go first to the S&P 500. I do apologize if I sound a bit congested. I came out of my extended 3-day weekend, a little bit of a head cold. It's mostly gone. I think it's just the bad air quality plaguing Central Texas currently. So, hey, let's hit it. We're going to take you through our view of the S&P 500, starting with the 195-minute half-day time frame. So this is essentially looking at the entire correction going back to the all-time high in the S&P from January 4th. And what's been really interesting about this overall move is the most appropriate way to count it, per the rules and guidelines outlined by Robert Prechter in the most recent edition of the Elliott Wave Principle, is the wave count that you see here in front of you, which is actually a more complex scenario that I feel is justified based on the complex environment we've been in, economically speaking, and with the geopolitical tensions that arose, earlier in the year. So this may be, and I think this could be, the first instance where we truly have a quote complex correction that prints and completes in the major U.S. market indexes. So going back to January, the top kind of house count here at Trading Analysis would be to suggest that we have simply been in a series of Elliott Wave corrections that have been connected by two Elliott Wave corrections. So we essentially have 3 corrections moving against the higher degree uptrend that still remains intact, moving from the bottom left-hand corner to the top right-hand corner of your screen. And then along the way, we have the X-Wave connectors. The last clear, actionable takeaway that we presented you all with, I feel, was going back into the August 16th high. And if you'll recall, we had been tracking price action coming off of the June low in one of 2 ways. Either the June low marked the end of the correction, and this was simply a double combination, and we were in the process of resuming impulsively on the upside, or alternatively, the summer rally was going to prove to be just 3 waves. So we had this labeled as either ABC up, or up in 1, down in 2, up in 3, down in 4. And going into mid-August, we had advised an expected wave 4 pullback, or the start of or resumption of the downtrend for 2022. And that assigned a really clear uptrend and validation level that we offered and brought your attention to at 39.45 in the S&P. And from an Elliott Wave perspective, a move under that level essentially, in my opinion, confirmed new lows for the year. So the minute we broke south of 39.45, that was our trigger to go ahead and suggest the move back to 36.36. And here we are. We've met the new downside low for the year, and now we're starting to see some interesting price action in the indexes, as well as the tech and discretionary sectors, while we're seeing the dollar index come off, as well as Treasury yields. So it is entirely possible that we just completed this overall triple combination correction. Now, thanks to Elliott Wave, we were able to navigate this overall decline quite well with our clients. We identified the end of the August 16th decline. We're able to put a short position to work within 1 hour of the market reversal. And I've had 3 successful index shorts along the way down, targeting that move down to 36.36. So if this wave count is true, then we have evidence to say that the correction may be in and that the indexes may be attempting a more significant low. And if this is the case, it really completed as one would expect, with a 3-wave subdivision in the wave Z position. Now, given this is a more complex scenario, and also given the fact that the NASDAQ, the Russell 2000, and the Dow Jones Industrial can be counted in a more simple manner, I think it's at least worth acknowledging the possibility that maybe this is an instance where we truly have just a standard ABC correction. So instead of this being a series of Elliott Wave corrections, maybe this is just a standard zigzag. And if this is in fact the case, that would put us in a wave A down to June, wave B back into August, and that would mean, unlike the triple combination, which would require completion with a 3-wave decline from the August high, such as you see here, down in A, up in B, 5 waves of C, which we can identify, the alternate, more simple scenario would suggest that this is just an ABC zigzag. And if this is an ABC zigzag, wave 5 does need to complete, or correction, wave C does need to complete with a 5-wave decline. And if this is at work, then there's the possibility we're going to see the S&P meet resistance here between 37.98, let's call it 38.10, And if the S&P is to hold resistance here, that's when I would be looking for one final move to the downside near 3469 to 3500. Why is 3469 to 3500 an area of interest for me personally? Well, as Todd pointed out, that is exactly where the 1272 external retracement of the summer rally comes in. The 1272, as you can see, I already have it outlined here, is at 3469. And you'll also notice that if we take into consideration the parallel corrective trend channel going back to the all-time high through the B wave with the parallel trend line over the low of wave A, we would essentially see wave 5 meet that zone. So plan A, we look for evidence of completion of the triple combination. Plan B, we watch resistance in wave 4, and in the event we start to see markets turn lower, that's when I'll be looking for the 3450 to 3500 downside target. So that's the S&P 500. And then in the event we start to see markets kind of hesitate to the upside and perhaps enter sideways, contracting triangulation, maybe we're just going to go in a long B wave. And if this is the case, I would encourage you all to get set up with a team that can help you along the way. We would encourage you to visit us at tradinganalysis.com. But it's been an interesting year. Let's touch base on the Russell 2000. Here in the Russell 2000, I think the idea of the complex completion is completely valid. Here in the Russell 2000, the triple combination possibility, you'll notice, does have evidence of 3 waves down in wave Z with an equality measured move. I would be looking for the same possible alternate scenario where the wave 4 meets resistance somewhere between 1760 and 1773. That could give you one final journey to the downside in small caps. And then over to the NASDAQ, we'll bring it full circle. Looking at the NASDAQ, we've got the same situation at work. Either the decline from August completed as 3 waves, and that was the end of the triple combination for 22, or alternatively, this is simply a wave 4, and we have one final journey south. So that's it from me this morning. Let's jump back over to the team, and we'll get them set up here. Yeah, you'd have to go back to August and September.
Yeah, good call. Yeah, we didn't mention Aaron Judge, man. 62 home runs. That's amazing. Did you guys see him jump over the wall and he already got offered $2 million for the ball?
Really? My goodness.
There was the prices of outfield tickets on StubHub were being bid up so much just for the chance for somebody to catch 61 and 62, and the guy already got offered $2 million for the ball. It's amazing.
It's a heck of a catch.
But well, no, he jumped over and he didn't break his neck. Luckily, I think he was okay. And then they escorted him out so he didn't get tackled and people didn't steal the ball. But yeah, no, that's there's a lot of bearishness out there in the market. There's a lot of sort of macro forces that Alex will talk about that are starting to kind of bring light to the wave count. Might have potentially finding a lower. I think the big LIQUIDITY community is at large continue to be bearish. So I think it's important to look on both ways. But Bennett, I'm going to take the screen real quick. Sure. I told you to do something and you didn't. I love you. You're too nice. You're a lousy salesman. I'm going to be honest with you.
I accept it. Take it away. What do you got?
Well, I mean, the guys here at Trading Analysis are always just throwing such good information to you guys every week. And, Bennett never wants to take a minute to pat himself on the back. I mean, you just look at, as you said, the last couple SPX trades. So we're short on, this is what the guys did. September 20th, paid 720, took them out at 12.5, and then managed profits well at 860. So as the market was coming back, don't let a winning trade turn into a loser. And then going back SPX again, short on the SPX via an option structure 9, took them out at 1130. Tesla trade, and then another one SPX here, got him at 610 and pitched him out at 11.5 and 13.5. So good trade in there, techs. I mean, that's the kind of stuff the boys are offering. So, you find that, again, with the LIQUIDITY work that they're doing, I find going back to that Twitter conversation at the top, it lends itself really well to index trades and options trades. So, So definitely check that out. Sending it back over to you. I think, Terry, you're going to go up next unless you guys want to talk about that.
Yeah, I got it.
Appreciate it. Yeah, it's been a lot of fun navigating clients through those trades as they have unfolded off the August 16th area high, and it's been a challenging market, but we've had a lot of fun, and thanks to Elliott Wave, we've been able to stay one step ahead of it.
It's not just Elliott Wave too. It's proper application. It's patience. It's looking at multiple scenarios and having an ongoing discussion like we do, and looking at the multiple possibilities, trying them on, seeing how they fit, and looking for good entries in the market. And a lot of that's why Elliott Wave, I think, is a horrible forecasting tool, but it's a wonderful trading tool for risk management, multiple scenario analysis. It's a big conditional statement. If ABC happens, then we're going to do D. If X happens, we're going to do Y. If Z happens, we're going to do whatever. So just think of it that way rather than a one-dimensional long-term forecasting tool. It's a great trading tool.
Absolutely. All right, Terry, you ready to take us into Optima? Take a look at some sector rotation.
All right, let's take a look.
All right, take it away. We'll be back on the other side. Catch you guys in just a few minutes.
Hey traders and investors, I'm Terry Long at tradinganalysis.com with your weekly sector focus. So third quarter trading ended last Friday with the S&P declining 9.35% in September. But now investors are looking to begin this fourth quarter with expectations of a trend change in the making. Now, will we see that, or will we see more pain in the months ahead? Now, first, let's wrap up this third quarter markets, which finished last Friday with the S&P declining another 2.91% in the final trading week of the quarter. 3 of the 4 weeks were in red for September. The index tacked on another 3.01% loss, netting a 10.6% decline for September. But in the first 2 days of trading this week, the S&P has rebounded 5.73%, over half of September's declines. This whole month, half of it wiped out here in 2 big days. NDX has returned 5.57% also in 2 days, just slightly less, notably slightly less than the S&P here. Now, last week, looking over here at the sector performance, 10 of the 11 sectors closed the week lower. The energy sector in the prior week had dropped 10%. And this last week, it recovered 2.19% of that. The utility sector, which is actually our top relative strength leader, last week fell precipitously. I love using that word. Down 8.71% for the week. But you know what? Materials, healthcare, financials, industrials, communication, and consumer discretionary last week, even though they were in decline, outperformed the benchmark S&P. Let's fast forward to this week, where we currently have all 11 sectors in the green. Energy here out of the gates with almost a 10% move. We'll pull this little table open. You can see pre-market action here. We're up 10.01% on the 2 days in the pre-market action. Energy getting a big recovery here. Now, the utility sector fell. I got that. The utility sector fell. Let's see here. Where we're at. Lost my place in my notes here. Materials, technology, industrials, and financials are up more than 5% each here. The worst performing sector was the real estate sector until the pre-market action. Now it looks like real estate's getting a little bit of a bounce back. It was down pretty good. Now it's the consumer discretionary kind of just holding on with a 1.68% gain here. All right, let's move on to look at our relative strength sector leader scoreboard. Now, while the utility sector remains in first place with a relative strength score this morning of 103.9, that huge drawdown last week has curled the XLU's rising vector. You see that little bit of a turn there, and then the velocity kind of just fell off of the XLU's rising vector. Okay, it's still holding the highest relative strength, but there's indications that maybe it wants to start to fade. Now, the energy sector not only has returned to the leading quadrant, but it actually overtook the XLY consumer discretionary sector for second place over here in our relative strength sector leader scoreboard by just a little bit. That momentum fade, don't count the consumer discretionary sector out just yet. It still sports 102 relative strength ratio. A little bit of momentum fade there. Excuse me. The industrial sector has actually seen price improvement, and its vector has shifted from yellow to green now. Here, let me animate that, and we'll show you industrial sector now pushing up into the improving quadrant with a little bit more impetus there. Now, coming out of the improving quadrant, this financial sector has morphed that rising blue weekly trend vector. It was green yesterday when I looked at it. It looked like it's still holding on to that blue trend. But this last tail, I'm seeing a big push here, some high velocity moves here as the XLF looks to be ready to cross over, possibly by next week, back over here into the leading quadrant. Now, the technology sector has faded. The technology sector did put in, the XLK stocks, they're not the ones that are really the ones outperforming right now. Matter of fact, they're performing very similar to the S&P. It's the consumer discretionary, industrials, energy, and then even these financials. Those are the sectors where things are really happening. This is not a tech-led rally. Let me just say, put it that way, which to me possibly also leads credence to Bennett's 5 waves down in the fact that this may simply be a bull trap. So be on the lookout for that, because technology stocks are kind of neutral right now with relative strength and momentum almost the same as the S&P. Now, down here in the weakening quadrant, the staples and healthcare sectors are showing some attempts to recapture upside momentum. Staples a little weaker, but healthcare definitely has returned back with this northeasterly vector. And when it's northeasterly, that means it's gaining momentum and relative strength simultaneously. There's several stocks in healthcare that are looking really good right now. Now, remaining over here in the lagging quadrant is real estate, materials, and the communication sectors, which are still strongly underperforming the benchmark. Now, the materials sector's recent rising momentum has seen it just on the edge of returning back into the improving quadrant. Okay, so be on the lookout for an upthrust here that'll push the XLB back in there. And then I think that will probably have the XLF over in the leading quadrant. Materials will be the only sector sitting in the improving. I say that, but again, communications has been our worst performing sector for quite a while. I do have a rapid hook reversal showing here. There may be things, perhaps this is influenced a lot by what's happening in Twitter, but there is some certain rotation happening here in the communication. That's all I've got for now, Bennett. I'll send it back to you.
Very good. Much appreciated, Terry. Interesting to see the weekly development there for the technology sector, and it would support the idea that perhaps this is a way for, with one additional move to the downside still left to go. But even if that proves to be the case, I think we're all in agreement that it would likely be at or near the corrective low. All right.
All right, Alex got the screen.
Yeah, screen is okay, I think.
All right, you ready to rock?
Yeah, let's
right.
go.
Take it away. If you could take us through the dollar. I don't know if you've been tracking the ending diagonal potential that we talked about, but I'm sure you're going to cover it. I see you got the 10-year ready to go. If I see any questions coming your way, I'll pass them your direction.
Sure.
All right, take it away, Alex.
Hey guys, let's go over the macro themes. We finally found out what was the problem in the UK last week. So actually the big pension fund managers has some long dated exposure, and they were asked to submit collateral because of the margin calls, and that actually collapsed the gilt markets, and Bank of England was actually intervening on the market to stabilize that event. So finally, we got the words what was the cause of this intervention. We don't know the depth of it, but we at least know what has happened. So on the US 10-year, we are still tracking two wave counts. I think we are still trading in the zone, and as we come to the target rate for the Fed, which now ranges from 425 to 450, next hike most likely will be 75 basis points. So the propensity for the Fed to move rates higher, I think, will diminish with time. And my case for dollar, which I will just go in a minute, is that the other central banks still has to ramp up pretty quickly rates on the upside, so the interest rate differential will squeeze, and that will be one of the, I think, themes that will actually reverse the dollar moves on the upside. We are seeing some signs of it. So also, I think that rates are in the terminal, either a sideways consolidation in this way for one more push on the upside, and then a relatively dire reversal, or we're going to reverse from here in a 5 ways down and then go directly in the next 6 to 1 year to the downside level. So we are still observing this, and of course trying to pair it with the macro themes. I like this wave count because it kind of aligns with the European rates, although Europeans are lagging. So we have seen a pretty nice hold here in this intermediary wave 4, move up in a wave 5. So the rates on the European front will go on the upside. Lagarde was very vocal last week. They're going to hike rates every meeting. She didn't say, of course, in which magnitude. But I think as they are trading now at 1.25 official ECB, I think they're going to go either 50 or 75 basis points to 2. And as I see the euro-dollar markets, futures are going up to 3% and then stabilizing. So I can also show you that. That's always something interesting to look. So let me just find that. I didn't prepare that in advance, but since I'm mentioning, I'm going to show you that chart, which is actually telling you how the market is predicting the euro-dollar futures, or Euribor, 3 months and 6 months and 1 month. So as you can see, we are going up to 3% in all of 3 durations. This should go until, let's say, June or April of 2023. So as considering we are now at 1.25, we are going the next couple of meetings up to 2.25. So as the market is looking for rates to go up to 3% and actually stay at that level for the considerable amount of time for the next couple of years. At least this is the situation on the futures now. So this chart kind of explains this relatively nicely, because you have intermediary wave 3 either finish or a little bit more upside, move down in a wave 4 in some type of a consolidation, and then actually this cycle might finish around 3% in the next year or year and a half. So I think it's a good representation technically of what we are seeing in this euro-dollar futures or Euribor futures markets, what they are predicting. So I think these two pairs, although the propensity now is on the side of the European Union, because they're going to hike larger increments than the Fed in the next couple of meetings. So I think Fed might hike 75 basis points once more, but I think they're going to decrease the increments as they're approaching their target rate. So this will be affected, and this will be seen in dollar. Our resistance levels from 112 to 114 are holding for now. We had a nice push to the downside, but the overall structure on the smaller time frames, as you can see, has only 3 waves up. So this is the only type of the pattern which kind of resembles the ending diagonal features. So we think we're going to see one more pop up. We might consolidate a little bit here until this price actually crosses this blue line and actually enters the territory of these 3 waves in wave 1. So the ending diagonal or the leading diagonals are the only patterns in the Elliott wave world where you can actually overlap, and it is required for the price action to overlap so we can account this pattern to be completely valid. So point taken, Bennett. I think also we are in the ending diagonal, but I think the resistance levels might stay the same. We might pop a little bit around this level, around this channel, and then reverse strongly to the downside in the next couple of weeks. So as our team was for this couple of weekly YouTube streams, that the dollar is in the end cycle, I think we are starting to see the first event of that, because this pattern is very telling if it unfolds, and most likely it's going to unfold. So let's look what is going on the commodity spectrums. Nothing much. Thomson Reuters index are still moving lower. You can have a bits of pieces in these corrective pullbacks in some form or the other, but I think the move most likely it's still not finished to the downside. So I'm going to stay relatively bearish short term on a couple of commodities. Oil is also moving towards this great support level, which I see on Brent between 66 and 75. So I also think this is not finished. I think this is just an ABC X, some type of an ABC complex correction. My take on the S&P will be, however you interpret it, either a B wave triangle or the X wave triangle, which kind of also aligns with this oil wave count, with the S&P a little bit lower after this triangulation is done, at least for this moment. So I will pair that up with this possibility that we are going to go and move lower still in oil. We have also read a couple of articles that the OPEC is already thinking of reducing supply to stabilize the price. Of course, OPEC is a cartel in a sense of making the price of production increasing and decreasing supply. So they already started to talk about reducing supply to stabilize the price, but I think inevitably the price might still go a little bit lower. So if we also look the net gas, we don't have any signs yet what's going on there. Definitely my take on this one is either a larger wave 4, or this is already start of the wave 5 in a 1-2, and we move to the upside. I need a little bit more data actually to either anchor wave 3 here or here. But I think, as I said before, definitely I think the net gas, also from the seasonal reasons and what's going on in the world, will still continue further on the upside, while either from here or this correction can take a little bit longer, sideways movement a little bit lower, and then we're going to go up to 13, up to 15 on this Henry Hub futures. So let's revisit gold and silver. An interesting development there. Our levels on the dollar comparing to the golds are matching nicely. It doesn't mean that the gold actually posted the low. We have seen nice 3 waves move on the upside, which can make this a final part of this ending diagonal, not being the end here, but in this region with one more push lower. But as an orientation, I always advise that you go on a higher time frame, wait for a clear 5-wave move on the upside as a confirmation, and then, as Todd says, Elliott is a great tool for managing risk. On a pullback, this will be my zone where I can actually very well define my risk reward on a possible movement up on the gold. So I think we are in the last sequence, 200 moving averages here. My interpretation of this is an ABC to the downside, this being either completed or one more push down to complete this ending diagonal in a C wave, which I also label as a 4th wave, looking for one more push on the upside in the gold market. So as silver is also pushing on the upside, I didn't see a fully developed five-way move. So as I said, for gold, it's also very, very true for silver. I do think we're going to go on the upside. For now, I observe this to be a corrective in nature. I'm waiting five-way development to challenge these previous swing highs. And the pullback will be my zone where I can very well define my risk if I'm interested. So only three ways on the upside. I'm still on the sidelines looking what's going on, but I think looking all of these macro themes and the potential reversal in dollar in a couple of weeks, I think we are also in the late stages of this silver and gold bottoming process, and I think we're going to see upside maybe in the beginning of 2023 or in the second quarter. So we will see how fast the charts will develop. So let me just give you a peek for tomorrow's Crypto Lab. So let's look what's going on a Bitcoin. So Bitcoin doesn't move pretty sizably either up or down. It's in a big sideways consolidation. My overall case for Bitcoin is that this is a five-way move, which is going to stop before wave count invalidation. This kind of pairs up with this triangle. In the S&P, we're gonna maybe spend some time going sideways, up in C, down in D and E. There is a couple of other solutions. If you are interested to hear them, you can visit tomorrow Crypto Lab, and I will speak more about this. But for me, this is just a big sideways. No, it's just a matter of pattern. Which one will actually conclude this fourth wave with one more push to the downside? I'm looking to trade this, but I think it's still early. For our members, I want to see if this is going to develop, in a couple of other solutions. As I said, if you want to see them, you can come and visit Trading Analysis YouTube channel and the Crypto Lab with Alex. Back to you, Bennett.
Very good. Much appreciated, Alex. I like that sideways triangulation possibility there for Bitcoin. I think it fits well with the overall decline.
Yeah, and I'm curious to see if Ethereum is making more headway than Bitcoin in here, and if that's like truly crypto's risk on, risk off indicator. But save that for tomorrow's Crypto Lab, Alec.
Yeah, sure. Of course. Yeah, we're going to look all of this stuff tomorrow, but in general, cryptos has been quiet in a sense that overall liquidity is impacting the crypto markets, and we are seeing bits of pockets of strength, like you said, in Ether and a couple of other them, but the rest of the space is relatively quiet for now.
Nice.
All right, Todd, I got the screen past your direction. You want to jump in?
Sure. Yeah, I'll throw a few things here at you. It looks like market's open. I was going to kind of echo on what Alex was saying on the macro front in terms of dollar weakness, and and I think Alan brought up a good point there. He said, TA team, what do you think about proposed OPEC supply cuts and Russian involvement? How can markets rise with higher inflation risk? I think the markets. I don't even think the markets are trading lower based on inflation fears. I think the markets are now priced, they're pricing central banks going too far. I think there's plenty of evidence out there in the way of commodities off. You look at the Case-Shiller Home Pricing Index, it was one of the largest drops in housing prices on record. We have commodities way off. We have housing prices way off. We have, I can show you the yield curve, 3-month, 10-year, 3-month. We're steepening again. It's not an inflation problem right now. It's central banks going too far, and the fact that RBA was the first to blink and didn't act as aggressively as they would is one of the main reasons that the market rallied. So I think it's more fear of central banks rather than sustained inflation. So I think, you look at energy. I have been overweight energy for a good period of time, and actually added a little bit more to the portfolio. I was significantly overweight a year ago. Kind of been peeling it off in the middle of 2022. And I just put a few 100 basis points more exposure in energy. And I think if actually commodities start to come back, I think that's a vote that from the market that central banks around the world aren't going to get out of control with raising rates. Just my opinion. But and we can debate that at the end. So Alex, and I actually was going through some country ETFs, and I'm actually starting to see some countries ETFs start to gain standing against the U.S. market. So I'm benchmarking against the S&P. You're starting to see in the leading quadrant right here. Just look at some of the names. So this is filtering by S&P monthly leading position. So on a month-over-month basis, you're seeing the Canadian ETF, Mexican ETF, Saudi Arabian ETF, Qatar ETF. Those are very commodity-based countries showing relative strength to the U.S. Whether you agree or not on my inflation commodity interpretation, the fact that those ETFs are gaining on the U.S. I find is interesting. And then you go into the improving quadrant here: Brazil, South Africa, Singapore, Japan, Australia, Peru, Philippines, like Chile. These are interesting developments here. So just kind of keep an eye on that. Going back to the market, I want to look at the internals. The S&P, it's all about the June bottom. We saw some pretty significant momentum divergence, and there's several different wave counts. Basically, is this 1, 2, or is this AB? But the fact remains that it was a slop fest down here over the last 2 weeks, which is going to create that momentum loss. And then, it was not hard to see this move up here that we've seen. And how far does this maybe bear market rally go? We'll have to watch the internals and see if it turns into something more. And one indicator that I'm watching a lot here, and again, I'm watching this market like I'm a day swing trader again as I'm managing longer term portfolios. But you look at the tick. This is the NYSE tick, the amount of upticking stocks versus downticking stocks. And this will indicate institutional buy-sell program presence. So institutions come in, they hit a button and buy all 500 stocks in the S&P. That's gonna get the tick moving higher. So anytime you're at 500, 600, 700, that means there's 5 to 1,000 to 1,500 more upticking stocks and downticking stocks. That's second on the New York Stock Exchange, which again indicates institutional buying and selling. And I throw a moving average on there just to kind of smooth it out. And what you'll see here is on the moving average on the way up, if we break above sort of this high, and I'm looking over here at the moving average, 400, 450, that sets up pretty good strength in the market. You had a moving average reading of 411 and we moved up. Then all of a sudden, look, as we're up at the top, look at the tick. The tick moving average made new lows that we had not seen on the whole rally up, and that's ultimately what reversed the S&P. So what I'm watching here is there seems to be a pretty good resistance on the 10-period moving average of tick right around 250-ish, right? So we failed a couple times. We tried to get above it on this most recent move up. Ticks are falling away, and it looks like we have a pretty good sell print there, minus 1,700 on the open as the markets are down. So, if the market were to somehow hold Elliott and Fib support here in the S&P, I'd want to see this start to move above resistance, and that would indicate, I think, that the balance of buy-sell power on the institutional side is there. So just watch that. What else? Fun chart. I thought we talked about Tesla. As I said, I'm going to throw some random stuff at you, but I had, about 15 minutes to kill. So I went over to Canva and put Elon in the pits. This is the CBOE. Threw his face on a floor trader, and you guys should know as traders, palms out means you're selling, palms in means you're a buyer. So he's selling, and I think, following that Twitter deal, you look at Tesla leading up to the announcement of the Twitter deal, Tesla, consumer discretionary, Tesla, S&P. I talked about Tesla on CNBC yesterday, and there's so much distraction with this Twitter deal, and so many people are losing fact that the deliveries out of Tesla were amazing. The numbers they're putting up are amazing. The margins that they're putting up against traditional automakers are amazing. Tesla is, I said on air yesterday, I'm not a Tesla fanboy. Sorry, whoever has a Tesla. I still think the cars are ugly, but you look at what they're doing, and from a fundamental point of view, from a technical point of view, this is why it's one of the largest holdings in my growth portfolio. The point of this chart is, you look at the outperformance of Tesla versus XLY and S&P, all of a sudden it gets smoked. And you look at the volume in Tesla, for me, going from mid-August through September, and compare that at the same time to the SPY volume. Yes, SPY volume increased, but it looks like if you were to do sort of an apples to apples comparison, how much did volume increase at the end of August and September in the S&P versus what it did in Tesla? I'm just eyeballing this one, but it kind of looks to me that there was more volume being done in Tesla than there was in the S&P. So I'm wondering if, all of a sudden there was some liquidation, and we'll find out, through filings. I don't know. I thought it was interesting. I mean, it's anecdotal. It's kind of a fun chart, but pretty good weakness there in Tesla. All right, what else did I want to show you? I was going to show you sort of just. Oh, wait a minute. Terry, I can't believe Optima's holding up for me right now. Okay. I wanted to show you this too quickly. This is the week over week relative rotation benchmarked against the S&P. So each one of these dots represents 1 week. And what I can't help but notice is look at the ETFs that are up in the top right quadrant. Russell 2000 growth. Russell mid cap growth. And what's interesting is the 500, so the top 500 stocks, market capitalization are still in the leading quadrant, but they're falling away. And then here's the top 200 growth. So they're still in the top right quadrant, which is indicating our performance relative to the S&P, but it's the small and mid cap growth. So maybe it's companies that have less international exposure, domestic companies that are where we need to be focusing if in fact this market does start to come back. But we are starting to see a little bit of value gain some steam here. They're heading to the top right here. So we have the 500 value, top 200 value. Those are obviously large cap value. This is the small cap 2000 value. So point stand, small caps outperforming on the value basis the larger capitalizations values, right? So you've got mid cap, small cap value coming in, but again, not near where small cap, mid cap growth is. So that's another, for me, kind of constructive sign. All right, let's get over this real quick. So this is just sort of a crude way to look at credit spreads. So this is the S&P in white against high yield TLT. So HYG, TLT, it's not really comparing the right way to look at credit spreads, because HYG, I think the average durations, like 4 years, where TLT is going to be 20 plus year, 30-year bonds in terms of duration. But what you can see is, anytime the S&P takes a drop here, HYG, TLT drops. Again, right here, S&P in 2011, little drop, HYG, TLT drops. Not so much here into 2015, but clearly we dropped away here in 18 and then followed in COVID as the S&P was moving lower. So is HYG, TLT. But what's interesting is for here, we have a pretty strong move going on right now in HYG, TLT. So high yield sort of junk, and you could substitute J and K in there as well. So we're actually seeing better outperformance for the more risky segment of fixed income, higher yielding fixed income relative to government treasuries. Historically speaking, that's got to be a risk on signal. You look at consumer discretionary, consumer staples. We have come off here discretionary underperforming staples, but uptrend support going back to credit crisis still very much intact, very much. Okay, so as XLY, XLP has come off, so has the S&P, but we're significantly off the lows. And you could even do a little Elliott wave count there in XLY, XLP, 1, 2, 3. Support seems to be holding right about here. And then if we start to move up, then okay, so consumer discretionary continues to outperform consumer staples, which again, an economy that's so paralyzed and crushed with inflation, why is consumer discretionary sector doing so well? And then I took a screenshot yesterday within the consumer discretionary industries. Why are travel, casinos, leisure, gambling, internet, retail, not so much that, auto, luxury, recreational vehicles, lodging, footwear, is it short covering or is it more than that? These are not industries that should be leading an uptrend when we have a very extended, leveraged, credit card debt-ridden consumer, which is what we're reading about in traditional media. And I'm saying something doesn't square up with the market. Something isn't squaring up. So I did a video for the wealth management business 2 nights ago. I did it from 12 p.m. to 5 a.m. So hopefully it made sense. But I just made the point that there's a lot of people talking out there, talk, and you really should be listening in this kind of market when you're running money, your own money or other people's money. You want to hear what everyone's saying, but I think you should be doing a little bit more listening and watching. So, if you actually listen and watch and see what's going on, there's a lot of pockets of underlying strength that doesn't quite square up with the extreme bearishness that the collective they out there are wanting us to believe. Technology, XLP, as the stock market's breaking down, tech XLP is holding in really, really well. If you break through this, okay, tech is losing steam compared to XLP, but it's certainly, you can see the clear relationship between the S&P and tech XLP, and it's holding up pretty well. Think that was it. Oh yeah, just going to finish with this one. This is long-standing iShares value growth ratio. So value is clearly underperforming growth for a long period of time. S&P drops off, value outperforms growth, comes back, is attempting to hold this now, formerly resistance, now support. Seems to be we're kind of losing some upside momentum. If this breakout, if this reversal since 2008, so I guess that would be 14 years of value underperformance relative to growth. If it's truly going to end, we need to not only break resistance, hold support, but then continue on up. And it remains to be seen if that happens or not. Resistance has been broken, but now it's got to take the next step and continue higher. And I'm not so sure it's going to do it. I'm willing to look at all sides of the equation. We raised some cash in the portfolios. I put some hedges on in the case that I'm wrong. I'm willing to give up some outperformance on the upside if we do get another significant leg down. But I'm seeing a lot of signs that maybe it's not as bad out there as we think. Guys, back over to you.
Very good. Much appreciated. Excellent coverage as always. Markets are open here, as you can see, bottom left-hand. Oh, we pulled that away, but indexes did open slightly lower, holding support here near 3750 in the S&P 500. Members, we'll see you in about 11 minutes for our weekly member webinar. If you all enjoyed the content, please subscribe with notifications. Give it a thumbs up. Drop a comment. Helps distribute.
Click that thumbs up button for the trade analysis, guys. Please do. That would help us.
Appreciate it. And thank you all for taking time out of your morning to join us. We'll be back same time, same place next week. Check us out anytime, tradinganalysis.com. You can sign up for our mailing list. And of course, tomorrow morning, 9 a.m., Crypto Lab with Alex. Gentlemen, appreciate it. And
have a good day, y'all.
Thanks a lot,
we'll be
guys.
back. See you guys next week.
See you guys.
Take care.